Okay, breaking news style to kick things off. It is Tuesday, January 20th, 2026. And if you opened your portfolio app this morning and felt, I don't know, a distinct sense of whiplash, don't worry, you are definitely not the only one. We are looking at a market that is playing a massive, high-stakes game of tug-of-war.
That is putting it mildly. I'd say it's less of a game and more of a structural stress test for the entire financial system.
Right. So on one side of this rope, we've got falling inflation, and it's whispering all these sweet nothings about rate cuts, telling us everything is going to be fine. But on the other side, we have what this report is calling liquidity ghosts.
Yeah, ghosts from the end of last year that they just won't seem to fade away.
And plus some very real, very shaky geopolitical jitters. It just feels like a mess out there.
It's a complex landscape, for sure. But the defining feature right now is just contradiction. You have these valid data points telling you to be incredibly bullish, and then you have equally valid data telling you to run for the hills.
And they're both true at the same time.
At the exact same moment.
Which is why we're here.
Yeah.
Our mission today is to parse the data from the vivimoneyDaily report. We're going to look at the macro picture, the stock market, and crypto to figure out where the smart money is actually hiding. But before we get into all the weeds, just give me the headline. If you had to put this entire chaotic morning into one sentence, what is it?
Okay, if I had to distill it all down, the market baseline is that inflation is dropping. So everyone is betting on rate cuts. But, and this is the key, investor behavior is, schizophrenic. It is aggressively switching back and forth between offense, think AI, tech, and defense, so specifically precious metals. And it's all a reaction to political uncertainty and those liquidity memories you just mentioned.
Offense versus defense. I like that. That's a good framework. So let's start with the playing field itself, the macro environment. Let's get into the hard numbers on interest rates. What are the charts telling us this morning?
We have to start with the 10-year U.S. Treasury yield. It's currently oscillating between 4.15% and 4.23%.
Okay, let's pause right there. 4.23%. For the average person, that number is, it's just a number. But in the financial world, is that high, low? Where do we stand?
It's in a medium-high range. And that context is just crucial. We aren't at the historic highs of a few years ago, but we certainly aren't in the cheap money era anymore.
And what does that specific medium-high range actually do to the market mechanics?
Well, it acts like gravity, specifically for high valuation growth sectors. When yields are sticking around this, say, 4.2% area, it just becomes expensive for companies to borrow money to fund their growth. And that naturally suppresses the prices of those flashy tech stocks. It puts a ceiling on how high they can fly.
Because the risk-free rate is just compelling enough to steal capital away.
Exactly. It's a heavyweight on the ankle of the tech sector.
Okay, so I want to pivot to this term from the report that I think needs some explaining. Liquidity memory. It sounds like a title from a sci-fi novel. This is referencing the overdate reverse repo and the standing repo facility.
Correct. And this is where the, let's call it the plumbing of the financial system gets really interesting.
I think we need to break this down for everyone. What exactly are we looking at here?
Okay, so think of the overnight reverse repo. The on-NRP, it's like a savings account for big banks and money market funds at the Fed. When there's too much cash sloshing around, they just park it there overnight, earn a little interest. When they need cash, they pull it out.
So it's a buffer, a sponge for all the excess cash.
Exactly. It's a liquidity buffer. Now, the report highlights that the market is still spooked by what happened at the end of last year.
Right, around December 31st. What happened?
We saw this massive scramble. The on-NRP hit about $106 billion.
Yeah.
And the standing repo facility, which is basically the emergency loan window for banks, it touched roughly $74.6 billion.
And why do those numbers matter to us now, here in late January?
Because it showed the plumbing was getting clogged. It showed that even though everyone was saying, oh, there's plenty of cash, when the pressure was really on, everyone scrambled for safety at the same time. So even though we're past that date, the memory of that stress makes the market hypersensitive.
So investors are just constantly looking over their shoulders.
Constantly. They're wondering if the cash is going to dry up again. It's a recurring risk factor. If that buffer drains too low, volatility just explodes because suddenly trades can't settle.
It's like PTSD for the bond market. They remember the pain, so they flinch at every shadow.
That is a very, very accurate analogy.
All right, let's pivot to something that hits a little closer to home for most listeners. Inflation and employment. We said inflation is dropping. Is that just a green light for the economy?
It's a flashing yellow light, maybe, and it's a big maybe turning green. Core CPI and PCE data are showing signs of retreating. And that supports the narrative that the Fed can ease up, cut rates. But, and this is a big but, we have to look at the labor market.
The jobs report, what do we see there?
The December non-farm payrolls, they showed a clear slowdown. The economy only added about 50,000 jobs.
50,000, that feels low compared to what we were seeing last year.
It is low, and unemployment is sitting at roughly 4.4%.
Okay, help us contextualize that. Is 50,000 a recession low, or is it just cooling off low?
The analysis here is that the labor market is moving from overheated to normal. It hasn't deteriorated systemically yet. We aren't in a crash where we're losing jobs, but the heat is definitely coming out of the engine.
So the engine isn't exploding, it's cooling down, maybe a little faster than we'd like.
Precisely. And that speed is what makes investors so nervous. If it cools too fast, it stalls. A soft landing requires a very delicate touch.
And 50,000 jobs is flirting with stall speed.
It really is.
Let's talk about how this nervousness translates to let's call it the vibe check. The report mentions the fear gauges. What is the VIX telling us?
Well, the VIX, the volatility index, it's climbed into the 15 to 19 range intraday.
Is 19 high? I feel like I've seen it way higher during crises.
It's getting there. 20 is usually the psychological threshold where concern turns into fear. So being in the high teens, it signals that news headlines, especially the geopolitical ones, are rapidly raising the cost of hedging.
And hedging just means insurance, right?
Yes. People are buying put options. They're paying more to protect their downside because they're nervous about what they're reading. It means traders are expecting bigger swings.
But then I look over at crypto and it feels like I'm on a different planet entirely. What's the sentiment over there?
It's a bit of a split personality. The fear and greed index for crypto is in the 50 to 61 range. That's rebounding from cautious all the way to neutral positive.
So stock traders are nervous, buying insurance, and the crypto crowd is getting greedy again.
To an extent, yeah. It shows capital is still chasing assets in that space. They see potential rate cuts and think liquidity is coming back, let's buy. But the report does warn of significant short-term risks in chasing those highs. Just because the sentiment is positive doesn't mean the price action is safe.
Right. Speaking of price action, let's get into the core asset deep dive. I want to start with equities and, of course, our favorite buzzword, AI. And I'm looking at the broad market. What am I seeing?
Well, if you look at VOO, which tracks the S&P 500, it's just hovering in the $634 to $639 range. It's what we'd call high consolidation. The price is high, but the trading volume is really thin.
And thin volume usually means people are just waiting for something, right? It's quiet.
Exactly. They are waiting for direction. The conviction just isn't there yet. Same thing with the NASDAQ 100, ticker QQQM, trading around $255 to $258. The volatility there is almost entirely dominated by news coming out of AI and semiconductors.
Which, of course, brings us to the king of the hill, NVIDIA.
NVIDIA, ticker NVDA. Still the undisputed AI infrastructure leader. It's trading between $185 and $190.
$190 a share. That is robust.
It is the core of that offense strategy we talked about. But you should look at Meta and Google as well. Their valuations are being driven entirely by this tension between their massive capital expenditure on AI versus the actual health of the ad market.
So it's a battle between spending money to build the future and making money selling ads right now.
That's it, exactly. And investors are punishing them for spending too much, but also punishing them if they don't spend enough to keep up. And what's fascinating is how the capital is splitting across the whole market.
What do you mean by that?
Because the volume is so thin at the start of the year, we're seeing this clear divergence. Some money goes to AI, that's the offense. Some money goes to precious metals, that's the defense. There isn't really much in between.
A barbell strategy, all or nothing.
Pretty much.
Okay, so let's move to the other side of that barbell, crypto. And I also want to ask about these pre-stocks later, but first, the big ones, Bitcoin.
Right. Bitcoin is oscillating in a very, very high range right now.
Yeah.
Call it $92,000 to $96,000.
$96,000. We are knocking on the door of six figures again.
We are close. But the report identifies $95,000 to $98,000 as a key resistance level.
And resistance just means sellers step in.
Yes. Every time it gets to that level, people start taking profits. The decisive factors right now aren't just hype anymore. It's ETF flows, it's options data, and it's institutional buying. The market structure is becoming much more mature.
Less about retail speculation, more about institutional allocation.
That's it. And Ethereum is tracking right alongside. It's sitting at $3,100 to $3,300, behaving like a high beta version of Bitcoin.
What about the altcoins? Solana.
Solana's volatile, bouncing between $130 and $140. BNB is very sentiment-driven, somewhere between $889 and $20.
The report also makes a point to mention HYPE assets.
Yes, and the source is very clear on this. These are high-risk, high-speculation assets. They should only be a very small position. The report explicitly says, do not bet the farm on the hype.
Okay, now, I want to touch on this pre-stocks category. We're seeing tickers like Anthropic, XAI, OpenAI. These are anticipatory assets, right? People trying to get in before an IPO.
That's the idea. But I have to issue a really strong warning here, echoing the report. The secondary market quotes for these are scattered.
Scattered how?
The pricing just isn't transparent, and the liquidity is really poor.
Meaning if you buy it, you might not be able to sell it when you want to.
Exactly. Or the spread between the buy and sell price is massive. You might buy at $50, and the best offer to sell is instantly $40. The report says these are for extreme small position speculation or hedging only. The risk of getting your capital trapped is very, very real.
So maybe don't put your retirement fund into a pre-stock for a company that hasn't gone public yet.
I would highly advise against that.
Now, we've looked at the what, but we need to understand the why. This is where it gets really interesting to me. Let's connect these movements to the news. The report highlights US-EU trade tensions. How does a trade spat across the Atlantic affect my portfolio?
It's all about the currency. This tension caused the dollar index, the DXY, to weaken briefly to about 99.00.
And when the dollar gets weaker, things priced in dollars get more expensive.
Exactly. And commodities tend to react. And wow, did they react? Look at gold.
Spot prices are hovering near historic highs, roughly $4,600.
$4,600 for gold. That is a staggering number.
And why is that happening? Is it just the weak dollar?
No, it's fear. Gold is the ultimate defense asset. But oil is moving too. Brent is at $64.13, WTI at $59.69.
And why is oil moving up? Is that just the trade tension too?
It's not just the tension, it's the demand side. The report points to Chinese data, specifically their 2025 GDP forecasts and refinery data, that is boosting demand expectations.
So if China's engine starts revving up again, they need more oil, pushes prices up.
Correct.
I want to circle back to gold for just a second because I saw a metric in the report that confused me at first. The BTC gold ratio. What is that telling us?
This is arguably one of the most crucial metrics in the whole report. While Bitcoin is high, trading near 96K, the ratio of Bitcoin to gold is actually trending down.
Wait, break that down for me. Bitcoin is near an all-time high, but it's losing ground to gold.
Because gold is rising faster, or at least more steadily.
What does that imply about investor psychology?
It means that gold, the ultimate defensive asset, is attracting massive capital flows as a hedge. Even though people like crypto, when push comes to shove, the big money is running to the safety of gold right now.
That is a very telling signal. It's like people are partying in the living room with Bitcoin, but they've locked the family jewels in the safe with gold just in case.
That's a perfect way to visualize it. It signals that underneath all the hype, there is deep systemic fear.
So what does this all mean for the listener? We've got the data, we've got the context. I want the game plan. Based on this report, what is the strategy?
The strategy outlined is defense first. It's a four-part plan.
Hit me with number one.
Core shield. Keep your broad ETFs, like VOO for the S&P 500 and QQQM for the NASDAQ, as your main shield.
So despite all the fear, don't sell everything.
No. Do not sell out of the market. Stay in the broad, safe currents. You need that exposure if the market rips higher on good news about rate cuts.
Okay, number two.
Hedge. You need a moderate allocation to gold ETFs or even physical gold. We just talked about why. Systemic risk is high. You need that insurance policy.
It's not about getting rich on gold. It's about not getting poor if everything else breaks.
Exactly right. It's ballast for the ship.
Number three, the fun stuff.
Growth. This is your AI and crypto. But the key phrase here is small batch.
Small batch, like bourbon.
Like bourbon. You sip it, you don't chug it. If you are entering NVIDIA or Bitcoin at these levels, $190 for NVDA, $96K for BTC, do not go all in.
So don't just dump your whole paycheck in at once because you have FOMO.
Never. Use strict stop losses or dollar cost averaging. You buy a little bit over time. If the floor falls out, you don't want to be fully exposed at the top.
And finally, number four.
Liquidity. And this goes right back to our liquidity ghosts. Keep cash or short-term bonds ready.
Why cash, though? Inflation eats cash.
Because cash gives you optionality. Watch that ONRP data. If liquidity turns and the market crashes, you want dry powder ready to deploy.
Dry powder basically means keep cash available so you can buy good assets when they go on sale.
Exactly. The market rewards patience right now. It punishes impulsiveness.
So to summarize the vibe today, We are living in a market of high rates, liquidity PTSD, and geopolitical nerves.
That's the trifecta. The market is waiting for a clear direction. It's looking at flows, where ETFs and funds are moving money, and it's watching politics.
And until that direction becomes clear,
The key isn't just what you buy. It's keeping enough options open, enough cash and bonds, to react when the tide turns. Because if we learned anything from the end of last year, that tide can turn very, very quickly.
defense priority. Volatility management. Don't chase the shiny objects without a helmet on.
Couldn't said it better myself.
That's it for today's deep dive into the Vivi Money Daily. We'll be keeping an eye on those liquidity ghosts. You don't have to.
Indeed. Stay safe out there.
And as a final thought to leave you with, we talked a lot about gold hitting $4,600 and Bitcoin hitting $96,000. But ask yourself this: if the defense trade, gold, is performing just as well as the risk trade, Bitcoin, what does that tell you about how much trust the market actually has in the currency itself? Something to chew on. Thanks for listening.